Every trader enters the market with a desire to win more, lose less, and finally break through the invisible wall that keeps consistent profitability just out of reach. Yet what most traders fail to understand is that improving your win rate has far less to do with finding a perfect setup and far more to do with reshaping the way you think, perceive risk, and respond to the market's constant uncertainty. The strategy that elevates your win rate isn't simply a technical method. It's a psychological framework that aligns your mind with the reality of trading. The market does not reward effort, intelligence, or potential. It rewards alignment with its structure. When you commit to a strategy that is built around probabilities rather than predictions, you begin to see the true path toward consistent winning. The key is developing a mindset that accepts uncertainty without fear, executes without hesitation, and evaluates each trade independently of the last. This is where most traders break down, not because they lack skill, but because they distort market information with expectations, emotional reactions, and the illusion of control. Improving your win rate starts with stripping away these illusions. The market is a fluid environment, constantly shifting, never obligated to behave according to your analysis. Your strategy must be built on principles that remain valid in any environment: clarity, consistency, and emotional neutrality. Clarity means understanding exactly what you're looking for, your setup, your trigger, your invalidation point. Consistency means applying that process the same way every time. Emotional neutrality means not allowing fear of loss or desire for gain to interfere with your execution. The strategy you are about to learn works because it removes the psychological conflicts that corrupt decision-making. Instead of trying to predict outcomes, you focus on identifying high probability conditions in which the market is more likely to move in your favor. You stop trying to control results and start controlling the variables you can: your mindset, your rules, and your ability to follow them. The power of this approach is that it reframes what winning actually means. Most traders associate winning with the outcome of each individual trade. But consistent winners think differently. They see each trade as just one event within a larger series. They do not attach emotional meaning to a single result because they understand that every setup has a distribution of outcomes. Win rate improves not by forcing the market to give you more winning trades, but by creating an internal environment that eliminates the errors preventing your strategy from performing at its highest potential. When you internalize this, your entire trading experience transforms. You no longer chase trades or fear losses. You no longer hesitate or overthink your entries. You begin to trust your process. And once your mind is aligned with your strategy, your win rate rises. Not because the market changes, but because you do. Accepting uncertainty without emotional conflict is the single most important shift a trader must make before any strategy can work reliably. Most traders mistakenly believe that uncertainty is something to battle, reduce, or avoid. They think that through enough analysis, prediction, or confirmation, uncertainty can be solved. But trading is built on uncertainty. Every moment in the market is unique. No two setups are ever identical. No signal guarantees an outcome. And no amount of intelligence or experience gives a trader the power to know with absolute certainty what will happen next. The market exists as a constantly shifting environment of probabilities, not certainties, and until a trader fully integrates this truth into their mindset, emotional conflict will continue to contaminate every decision they make. Emotional conflict arises when the mind expects certainty in an environment that cannot provide it. This conflict shows up as hesitation, anxiety, second-guessing, premature exits, revenge trades, or the need for excessive confirmation before acting. Traders want the market to behave logically, follow their analysis, and reward their effort. They want a sense of control, but this desire for certainty creates psychological pressure because the market does not comply with expectations. When the outcome differs from what the trader believes should happen, emotional discomfort floods in. This discomfort drives impulsive adjustments, fear-based behavior, and a breakdown of discipline. Paradoxically, the more a trader tries to avoid uncertainty, the more unstable their performance becomes. Accepting uncertainty does not mean ignoring analysis or acting randomly. It means embracing the reality that no amount of analysis can guarantee an outcome. When a trader accepts this fully, their relationship to the market shifts. Instead of needing to be right, they become focused on executing their edge. Instead of demanding certainty, they rely on probability. Instead of trying to predict the future, they navigate it. This reduces emotional tension because the trader stops resisting what the market inherently is, unpredictable at the micro level, but statistically structured at the macro level. The moment a trader stops expecting certainty, fear begins to lose its power. Fear in trading comes almost entirely from the need for something the market cannot give: guaranteed results. Fear of losing, fear of missing out, fear of being wrong. These emotions are not created by the market, but by the trader's internal expectations. When uncertainty is accepted, fear loses its source. The trader no longer ties emotional security to outcomes. Instead, security comes from their rules, their process, and their ability to act consistently. This is why traders who embrace uncertainty often appear calm, even in volatile conditions. Their confidence does not come from knowing what will happen next. It comes from knowing they can respond appropriately no matter what happens. Another critical shift in accepting uncertainty is letting go of the emotional attachment to individual trades. Many traders unconsciously believe that each trade represents something about them, whether they are skilled, competent, improving, or failing. This creates pressure to make each trade work, even when the market clearly signals otherwise. But each trade is simply one instance within an endless series. When uncertainty is embraced, a trader no longer views a single loss as a personal failure. It becomes just another outcome within a distribution. This perspective removes the emotional weight that crushes decision-making and leads to impulsive behavior. Accepting uncertainty also enhances clarity. When the mind is not burdened by fear or expectation, it can observe market information without distortion. Most traders don't trade what's actually happening. They trade what they want to happen or fear might happen. Their perceptions are colored by hope, panic, or the need to avoid pain. But when uncertainty is accepted, the mind becomes neutral. It sees opportunity when it is there and walks away when it isn't. This neutrality is what allows traders to follow their rules. There is no internal resistance because there is no emotional demand for certainty. This acceptance must be internal, not intellectual. Many traders say they know the market is uncertain, but their behavior contradicts that belief. They hesitate at entries because they want more confirmation. They hold losing trades hoping the market will come back. They widen stops because they fear taking a loss. They exit winners too early because they fear reversal. These behaviors reveal a deep psychological need for certainty. True acceptance means completely removing the expectation that the market owes them a predictable outcome. When this expectation dissolves, the emotional forces that sabotage trades dissolve with it. In accepting uncertainty, the trader also frees themselves from the illusion of control. The market cannot be controlled. Only the trader's own behavior can be controlled. When attention shifts inward, toward execution, discipline, risk management, and emotional neutrality, the trader becomes empowered. The need to control outcomes disappears because outcomes are no longer tied to emotional survival. This shift creates a mental environment where the trader can take trades without fear, follow their plan without hesitation, and accept losses without distress. The market becomes a place to execute edges, not a battlefield to fight for certainty. Accepting uncertainty transforms the trading experience in a deeply practical way. Entries become easier because the trader no longer waits for perfect conditions. Stops become easier to honor because losses are no longer threatening. Letting winners run becomes easier because the trader is no longer desperate to secure quick results. Every aspect of execution improves because the mind is no longer trapped in conflict between wanting certainty and facing a market that cannot provide it. This harmony between mindset and environment is the foundation of consistent performance. Executing every setup with absolute consistency is what separates traders who remain stuck in cycles of emotional decision making from those who build a stable, repeatable edge over time. Most traders believe they have a strategy problem when in reality they have a consistency problem. A setup that works only when followed halfway or selectively is not a setup. It becomes a random collection of actions influenced by fear, hope, impatience, or the emotional state of the moment. Consistency is the force that transforms a trading method from something theoretical into something reliable, measurable, and capable of producing long-term results. The challenge is that most traders think they are being consistent when in truth they are making small adjustments that they justify emotionally. They alter their entry because a candle looks too big. They skip a valid signal because the previous trade was a loss. They tighten their stop because they feel nervous, or they take a late entry because they fear missing out. Each of these micro decisions creates a break in consistency. Every deviation from the rules disconnects the trader from their edge and introduces emotional randomness into the process. When the results become inconsistent, as they inevitably do, the trader often blames the market or the strategy, not recognizing that the real cause was their inability to execute with precision. Consistency requires a deep internal commitment. It demands that the trader follow their plan exactly as it is written, without bending, adjusting, or selectively interpreting conditions based on how they feel. This is difficult because trading triggers the parts of the mind that crave comfort and safety. The mind wants to avoid pain, avoid uncertainty, and avoid outcomes that threaten emotional identity. Consistency requires overriding these impulses. It means training yourself to act based on rules, not feelings. It means placing your trust in the edge rather than in your emotional reactions. It means accepting that the market does not care about how comfortable or uncomfortable a trade feels in the moment. Building absolute consistency starts with removing ambiguity from your rules. A trader cannot be consistent with vague, flexible, or loosely defined criteria. Your setup must be objective enough that two different traders could look at the same chart and reach the same conclusion about whether the setup is present or not. The clearer your rules, the easier it becomes to follow them without hesitation. Ambiguity is the enemy of consistency because the mind exploits unclear situations to justify emotional decisions. When everything is defined in advance, entry trigger, stop placement, target, conditions for invalidation, there is no room for subjective interpretation. Another aspect of consistency is removing emotional shortcuts. Traders often act differently after a losing streak, a large win, or a long period of drawdown. They might skip trades out of fear, reduce size without a rule, add size impulsively after a win, or exit early because the pain of previous losses is still active in their mind. These reactions break consistency because they stem from emotional memories, not from the trading plan. Consistency requires treating every setup independently, as if it exists in isolation from all previous outcomes. The market does not remember whether your last trade was a winner or a loser. Consistent traders behave with that same neutrality. True consistency also requires an acceptance of randomness within the outcomes of a valid setup. Even the best strategy will produce losses. Even the most reliable pattern will sometimes fail. Consistency means taking every valid setup, even if the last 3 trades produce losses, because you understand that the outcome of the next trade is statistically independent from the ones before it. Many traders selectively choose which trades to take based on recent results, which destroys the edge. They take setups only when they feel right, skipping them when they feel uncomfortable. This emotional filtering turns a strategy with statistical potential into a random decision process. In addition, consistency involves maintaining uniform execution across different market conditions. The market might be trending strongly one day and consolidating the next. It might be volatile in the morning and calm in the afternoon. Consistent traders do not adjust their rules on the fly to adapt emotionally to conditions. They follow the same rules in both winning and losing periods. They understand that consistency in execution is what allows them to collect enough data to refine their strategy intelligently. Without consistency, feedback becomes distorted, making it impossible to improve performance meaningfully because the trader never knows whether a result came from the strategy or from an emotional deviation. Executing with absolute consistency also requires eliminating the need for constant confirmation. Many traders hesitate to enter a setup until they feel safe. They wait for confirmation upon confirmation, trying to reduce their anxiety by making the trade more certain. But every extra confirmation usually destroys the edge, reduces the reward to risk ratio, or delays the entry until the opportunity is already gone. Consistent traders enter when the rules say enter, no waiting for additional comfort. Comfort is not part of the edge. Rules are. Another dimension of consistency is cultivating mechanical behavior around risk. A trader cannot be consistent if they change position size arbitrarily, tighten or widen stops impulsively, or take partial profits based purely on fear of losing unrealized gains. Risk parameters must be executed with the same precision as entries. When a trader varies their risk because of emotional impulses, the entire distribution of outcomes for their strategy becomes compromised. Consistency in risk management preserves the statistical structure of the edge, allowing the strategy to express itself fully. The process of becoming consistent requires training, repetition, and self-observation. You need to learn to recognize the emotional urges that push you away from your rules. These urges will appear in many forms: hesitation, doubt, overconfidence, fear, impatience, but the consistent trader learns to act independently of these impulses. It is not that emotions disappear, it is that they lose the power to influence execution. This separation between emotion and action is one of the defining traits that differentiate consistent traders from inconsistent ones. Ultimately, consistency creates psychological stability. When you execute the same way every time, your mind stops being shocked by losses or overly excited by wins. You begin to see trading as a long-term process rather than a series of emotional events. The market becomes a place where you apply your rules, not a place where you react to discomfort. Consistency provides structure in an environment that is inherently chaotic. It allows your strategy to reveal its true performance. It gives you clarity about what needs improvement. And it builds the discipline required to become a trader whose results are not determined by emotion, but by the edge and the execution that brings that edge to life. Treating each trade as one event in a larger series is one of the most transformative mental shifts a trader can make, because it breaks the emotional attachment to individual outcomes and replaces it with a mindset rooted in probability and long-term performance. Most traders operate as if every trade is a personal test of their skill, intuition, or identity, which creates enormous psychological pressure. They interpret a winning trade as proof that they are competent and a losing trade as proof that they are failing. This emotional amplification distorts their ability to think clearly and follow their plan. When a trader instead views each trade as merely one event among many, they detach their self-worth from the short-term randomness that defines the market and free themselves to execute with far greater consistency. The core idea behind treating trades as part of a series is the understanding that any edge, no matter how effective, produces a distribution of outcomes. Some trades will win, some will lose, and some will break even. This distribution plays out only over a large enough sample size. A single trade carries no special meaning because it cannot reflect the true performance of the strategy. When traders forget this, they place excessive emotional weight on each outcome. A single loss feels catastrophic. A single win feels euphoric. These emotional extremes trigger behaviors like revenge trading, hesitation, skipping setups, or altering rules impulsively. The trader becomes reactive, unable to maintain consistency because they are trapped in the emotional ups and downs of individual trades. When you approach trading as a series, you begin to see that each trade is simply one roll of the dice within a system designed to produce profit over many iterations. You know that the outcome of the next trade has no relationship to the outcome of the previous one. This removes illusions such as, I'm on a losing streak, so the next one must win, or I just had a big winner, so the next trade is risky. These thoughts betray a misunderstanding of independence in probabilistic processes. A series-based mindset allows you to take the next valid setup without hesitation, because the only thing that matters is executing the strategy consistently enough times to allow the edge to express itself. A trade series mindset also eliminates the pressure to be right. Many traders sabotage themselves because they equate being wrong with psychological pain. They fear the feeling of loss more than the loss itself. But when you accept that some trades must lose for the strategy to work, the emotional conflict disappears. You stop trying to control outcomes and instead focus on controlling your process. The question shifts from, will this trade win, to did I execute this trade correctly? This shift is powerful because execution is within your control while outcomes never are. When the mind focuses on what it can control, fear diminishes, clarity increases, and discipline stabilizes. Thinking in series also allows traders to handle drawdowns more effectively. Every strategy has periods when results dip, not because the trader is doing anything wrong, but because probability unfolds unevenly. Traders who lack a series mindset often panic during drawdowns, abandoning strategies prematurely or making desperate adjustments that worsen results. But a trader who sees the bigger picture understands that drawdowns are simply part of the statistical cycle. They continue to execute calmly because they know that as long as the edge remains valid, the distribution will correct itself over a larger set of trades. This perspective protects them from the emotional volatility that destroys accounts far more often than bad strategies do. Another benefit of viewing trades as part of a series is the accountability it brings to your own behavior. When you judge your performance not by whether the last trade was green or red, but by how closely you followed your rules over many trades, you remove the noise created by short-term randomness. This makes it easier to evaluate whether a strategy truly works. Traders often misinterpret their results because they focus on too small a sample size. A handful of wins leads them to believe they've found the Holy Grail. A handful of losses convinces them to abandon a method prematurely. Only by thinking in series do you gather enough data to make rational decisions about the viability of your strategy. This objective perspective helps you improve your system without emotional interference. Treating each trade as one event among many also encourages patience. You no longer feel compelled to force trades or jump into marginal setups because you understand that the quality of each trade affects the overall series. Instead of chasing immediate gratification, you think about the long-term impact. A low-quality setup might satisfy a short-term urge to be active, but it weakens the statistical integrity of the overall series. High-quality trades may require waiting, but they preserve and strengthen the performance of the edge. The trader who thinks in series values selectivity because they recognize that each trade contributes to the broader distribution of outcomes. This perspective also dramatically improves emotional resilience. When every trade feels emotionally significant, the slightest fluctuation triggers stress, doubt, or overreaction. But when a trade is seen as just one of many, emotional intensity decreases. A loss becomes a small data point, not an event that threatens your confidence. A win becomes a statistical outcome, not a reason to become overconfident or impulsive. Emotional neutrality replaces emotional turbulence. This neutrality makes it easier to follow rules, because the mind is no longer burdened with excessive meaning tied to individual outcomes. You are free to think clearly, respond intelligently, and maintain stable execution. A series-based mindset also strengthens discipline. Instead of trying to avoid losses, you accept them as part of the sequence. Instead of chasing the feeling of being right, you focus on being consistent. Instead of reacting emotionally to each outcome, you behave like someone conducting a long-term experiment. You collect data, observe patterns, and refine your process with patience. This disciplined approach compounds over time, leading to performance improvements that emotional traders never experience. Discipline becomes less about force and willpower and more about alignment with a clear understanding of how markets truly work. Finally, thinking in series grounds you in the reality that trading is not about predicting the market, but about managing probabilities. You stop seeking certainty because you know it doesn't exist. You stop treating trades as personal successes or failures because you understand they are statistical events. You stop trying to force results because you recognize that results emerge naturally from consistent execution over time. The market becomes a place where you interact with probabilities rather than ego, fear, or hope. Each trade becomes a simple action, not an emotional event. This mindset anchors your decisions, stabilizes your emotions, and reveals the clarity required to trade with precision and confidence. Focusing on probabilities, not predictions, is the fundamental principle that allows a trader to operate in alignment with the true nature of the markets. Most traders enter the market believing they must know what will happen next in order to be successful. They try to predict direction, momentum, reversals, and timing with precision, and when the market behaves differently than expected, they experience frustration, fear, and self-doubt. This predictive mindset leads to emotional instability because it creates the illusion that certainty is possible. The market does not operate in certainties, it operates in probabilities. Every price movement, every pattern, and every setup carries a range of possible outcomes. The moment a trader stops trying to predict and instead focuses on managing these probabilities, everything about their trading begins to shift. A prediction-based mindset attempts to force the market into a narrative that feels comfortable. When traders become attached to predictions, they distort the information they see on the chart. They ignore signals that contradict their expectation. They hold losing trades because they believe the market will come back, and they exit winners prematurely because they fear their prediction might fail. This mindset is dangerous because it disconnects the trader from reality. It replaces objective analysis with emotional attachment. The market becomes something the trader tries to control rather than something they observe. The more attached they are to being right, the more blind they become to what is actually happening. A probability-based mindset, however, recognizes that the market is an environment of uncertainty. No pattern guarantees an outcome. No indicator eliminates randomness. No analysis removes risk. When you think in probabilities, you understand that your job is not to predict, but to identify favorable conditions where the odds are tilted slightly in your favor. This shift reduces psychological pressure because you no longer need to be right. You simply need to follow your system and let the probabilities play out over a series of trades. This creates emotional freedom. Instead of fighting the market, you flow with it. Instead of fearing uncertainty, you embrace it. Probability thinking also changes the way you interpret losses. When you're focused on prediction, a loss feels like a failure. It implies you misread the market, made a bad decision, or lacked skill. This emotional weight can lead to revenge trading, hesitation, or rule breaking. But when you approach trading from a probabilistic perspective, a loss is nothing more than an expected outcome within a distribution. It carries no emotional significance because losses are built into the edge. They are not signs of failure, they are part of the game. This neutral interpretation of losses is what allows consistent traders to move through drawdowns with stability, while prediction-based traders unravel emotionally. Another advantage of probability thinking is that it allows you to assess setups objectively. Instead of asking, will this trade work? You ask, does this setup meet the criteria that historically tilt the odds in my favor? This subtle shift removes fear and hesitation. You are no longer looking for certainty, you are looking for alignment with your edge. When a setup meets your rules, you take it. When it doesn't, you walk away. This clarity strengthens discipline and reduces the emotional noise that disrupts execution. You begin to trust the process more deeply because the process is no longer burdened with the impossible requirement of being right all the time. Probability thinking also improves your ability to manage risk. Traders who predict often risk too much because they believe strongly in their expectation. They feel justified in increasing position sizes because they are confident in their analysis. But probability-based traders treat every trade as uncertain. They never assume they know the outcome in advance, and as a result, they size trades rationally. They protect their capital because they understand that any single trade could go against them. This respect for uncertainty naturally produces healthier risk management, which is essential for long-term survival. Another powerful aspect of probability thinking is that it aligns your mindset with the way professional traders operate. Institutions, market makers, and large players do not attempt to be right on every trade. They position themselves where probabilities are favorable, manage risk aggressively, and allow the law of large numbers to work in their favor. They think in distributions, not predictions. They know that even the best setups fail. They understand that consistency comes from executing a probabilistic edge repeatedly, not from forecasting the market with absolute accuracy. When you adopt the same mindset, your behavior begins to resemble that of a professional. Your trading becomes more stable, more disciplined, and more resilient. Focusing on probabilities also prevents overanalysis. Prediction-based traders often drown in excessive information, thinking that more analysis will lead to more certainty. They look at multiple time frames, dozens of indicators, endless confirmations, and constantly shifting interpretations. This creates analysis paralysis, confusion, and emotional overwhelm. But when you operate probabilistically, you simplify. You identify the few variables that matter for your edge and ignore everything else. You build a consistent process instead of chasing certainty through more data. This reduction of noise allows the mind to remain calm and clear during execution, which is essential for high-level performance. This mindset shift also enhances adaptability. Predictive traders become stubborn and rigid. When the market changes character, they cling to outdated expectations because adjusting would require admitting they were wrong. Probability-based traders do not suffer from this rigidity. Since they never assume certainty, they observe the market more objectively. They notice when conditions shift, when volatility increases, when trends weaken, and when patterns lose reliability. This allows them to adapt their strategies when needed without emotional resistance. Adaptability is a natural outcome of probabilistic thinking because you're always observing, never imposing. Another important dimension of probability thinking is how it influences expectations. Predictive traders often expect the market to reward them for their analysis or effort. They expect trades to unfold smoothly. They expect setups to behave a certain way. When these expectations are violated, emotional disappointment follows. Probability-based traders expect only one thing: uncertainty. They expect variability, they expect the unexpected. This mindset protects them from emotional shock. They remain centered even when the market behaves erratically because they never required it to behave predictably. This lack of emotional conflict creates mental stability, which is essential for consistent decision-making. Focusing on probabilities also enhances patience. Predictive traders often chase trades because they fear missing the move they believe will happen. They react impulsively, forcing entries because they are emotionally invested in their prediction. Probability-based traders, however, do not need to be in the market constantly. They wait for their edge because they know that taking only high-quality setups is what maintains the integrity of the distribution. Patience becomes easier because there is no urge to predict or control. There is only the commitment to act when the probabilities align. A probability-focused mindset also builds confidence, not the fragile confidence that depends on recent wins, but a deep confidence rooted in understanding the nature of the game. You stop defining yourself by outcomes. You stop fearing losses. You stop chasing the need to be right. Instead, you build confidence in your ability to execute consistently within an uncertain environment. This type of confidence is unshakable because it is not tied to short-term performance. It is tied to the long-term expression of your edge. When you adopt this probabilistic approach, trading becomes less emotionally chaotic and more structured, intentional, and controlled. You no longer feel at war with the market. You no longer feel betrayed when trades don't work. You no longer feel desperate to predict what happens next. You become aligned with the market's nature rather than fighting against it. Every decision becomes clearer. Every trade becomes simpler. Your execution becomes more stable, and your long-term performance begins to reflect the power of thinking in probabilities rather than predictions. Removing expectations to eliminate hesitation is one of the most liberating internal transformations a trader can experience, because expectations are the silent force that binds a trader's mind to fear, hope, pressure, and emotional conflict. Expectations create an imagined version of the future that the trader begins to rely on emotionally. When the market fails to deliver that imagined future, the trader experiences discomfort, frustration, or anxiety, leading directly to hesitation, impulsive decisions, or reactive behavior. Expectations are not simply beliefs about what might happen. They are psychological demands placed on the market, and these demands create internal tension that disrupts clarity and discipline. When a trader removes expectations, they remove the emotional attachment to outcomes, which eliminates the hesitation that arises from the fear of being wrong or the hope of being right. Hesitation comes from the mind projecting into the future and anticipating pain. A trader expects a trade to win, so they hesitate because they fear the possibility of loss. They expect a pattern to behave perfectly, so they hesitate when it doesn't look exactly right. They expect the market to confirm their bias, so they hesitate to take setups that contradict it. They expect the last loss to repeat itself, so they hesitate on the next opportunity. Every form of hesitation originates from expectations that create emotional resistance. The mind tries to protect itself by waiting for more certainty, but in doing so, the trader breaks the flow of their execution and disconnects from their edge. Removing expectations removes the fear-based resistance that causes these breaks in execution. Expectations also distort perception. Instead of seeing the market objectively, traders see what they want to see or what they fear to see. When expecting a trade to win, they overlook signs of weakness. When expecting a loss, they overlook valid signals. The chart becomes filtered through emotionally tinted lenses. Removing expectations clears these distortions. The trader begins to see market information as it actually is, not as their mind wishes it to be. This clarity eliminates a huge portion of hesitation because hesitation thrives on doubt, and doubt thrives on distorted interpretation. Another way expectations cause hesitation is through attachment to outcome. When a trader expects a particular outcome, the mind becomes emotionally tied to that outcome. This attachment makes the trader fearful of taking the trade because they secretly want the outcome to be guaranteed before acting. They want confirmation not because the setup requires it, but because their emotional attachment to being right demands it. When you remove expectations, the emotional attachment dissolves. You no longer need the market to do something specific. You no longer require certainty. You simply take the trade because your rules say it is valid. The emotional weight disappears and hesitation collapses. Removing expectations also prevents disappointment from shaping behavior. When the market behaves differently than expected, traders often freeze or become reactive. A losing trade that contradicts expectations creates emotional shock. The trader becomes hesitant to enter the next trade, fearing a repeat of that disappointment. But when expectations are removed, there is no emotional shock. The outcome is accepted instantly as part of the distribution. There is no lingering emotional residue that carries into the next decision. This allows the trader to execute the next setup without hesitation, because the past no longer exerts emotional influence. Expectations strongly influence anticipation, which is another source of hesitation. Traders often anticipate movement before it actually happens. They expect the market to continue trending, expect volatility to increase, expect price to reverse, or expect a breakout to occur. When the market fails to fulfill these anticipations immediately, the trader hesitates, unsure whether to trust their rules or wait for their anticipated scenario. Removing expectations eliminates the need to anticipate anything. You no longer project imaginary futures onto the chart. You react only to what your setup requires in the present moment. This present moment awareness removes hesitation because hesitation lives in imagined futures, never in the present. Expectations also create pressure. When traders expect a trade to be a winner, they put pressure on themselves to avoid making mistakes. When they expect a big move, they pressure themselves to time it perfectly. This pressure makes execution feel heavy and stressful. Under pressure, the mind slows down, second-guesses itself, and becomes overly cautious. Hesitation is a natural response to feeling pressured. Removing expectations removes the pressure. Execution becomes lighter, quicker, and more fluent. You enter the trade because it's valid, not because you're trying to fulfill an emotional demand. Another important aspect is the relationship between expectations and confidence. Traders often tie their confidence to their expectations of success. When markets behave unpredictably and challenge those expectations, confidence collapses, which produces hesitation. But when you remove expectations entirely, confidence becomes rooted not in outcomes, but in your ability to execute consistently. This type of confidence is stable and unaffected by short-term randomness. Stable confidence naturally eliminates hesitation because hesitation is rooted in uncertainty about oneself, not the market. With expectations removed, confidence becomes grounded in discipline rather than prediction. Expectations also cause traders to compare reality to their imagined scenario. They hesitate because what they are seeing does not match what they expected to see. They question whether something is wrong with the setup, even when all criteria are valid. They hesitate because they believe the market should look or behave a certain way. Removing expectations removes this comparison. The trader stops demanding that the market match a picture in their mind and starts responding to what is actually happening. This alignment with reality eliminates hesitation because there is no internal conflict between expectation and observation. Another critical factor is how expectations fuel fear of missing out or fear of being wrong. When you expect a big move, you hesitate because you're afraid of missing it. When you expect a trade to fail, you hesitate because you fear being wrong. Both fears arise from imagined outcomes. Removing expectations removes the imagined futures that fuel these fears. You learn to act from rules, not from fear-based projections. The mind becomes calmer, execution smoother, and hesitation dissolves naturally. Removing expectations also creates mental freedom. When you no longer expect the market to reward you, you stop chasing trades. When you no longer expect perfection, you stop criticizing yourself for natural losses. When you no longer expect certainty, you stop hesitating to act in uncertain conditions. This freedom creates a mental environment where decisions flow more effortlessly. Hesitation requires mental friction. Removing expectations removes the friction, making execution feel simple and natural. A trader without expectations becomes emotionally neutral. Neutrality is one of the most powerful psychological states in trading because neutrality eliminates the emotional roller coaster that feeds hesitation. When you're neutral, you don't fear outcomes. You don't hope for outcomes. You don't resist outcomes. You accept outcomes as they are. This neutrality transforms the way you experience uncertainty. Instead of seeing uncertainty as a threat, you experience it as part of the game. With neutrality, hesitation has no fuel. There is no fear to stop you, no hope to trap you, no pressure to paralyze you. The mind simply follows the rules. When expectations are removed, action becomes easier. Clarity increases. Emotional noise decreases. The trader becomes aligned with the reality of the market. Decisions become sharper. Execution becomes more consistent. And hesitation, the silent killer of opportunities, loses its power because it no longer has a psychological foundation to stand on.